Hey guys, welcome back. In this particular video, we are going to talk about monetary policy. So, monetary policy, as you know, it is administered by RBI or the central bank, and through this particular policy, the central bank or RBI they generally manage the liquidity in the Indian economy. So this is one of the most important functions which is performed by RBI. So whenever you study the functions of RBI or the major functions of RBI, so monetary policy is one of those. Okay. So again, if you talk about the examination viewpoint, so this is one of the most important topic for your examinations from economics or banking awareness section. Okay. So here in this particular video today, we are going to talk about the basic introduction of monetary policy. What is monetary policy? How does it work and all? Then we'll talk about the process of monetary policy. And then we have monetary policy committee, which is a decision making committee about monetary policy. So we have 6 members for this particular one, which is known as MPC. Then we have monetary policy instrument. We have quantitative tools as well as qualitative tool. So we'll talk about quantitative as well as qualitative tools. Then we have type of monetary policy as well, right? So if you study newspaper and current related things, so the RBI or the monetary policy committee they generally come with quarterly meetings, okay, or bi-monthly meetings. In every 2 months there is a meet of this MPC. It is mandatory to conduct 4 times in a year, but if you see last 2 years, so in every 2 years in every 2 months they generally conduct this particular meetings, right? So what are like during that meeting is very important for all of you. Like sometimes they change the rates, or sometimes they come with some new policies and all. So you have to go through those particular one before your examination. Let's say your examination is scheduled in August month. So before the first meet is April, then there is a gap in May, then June, then August. So let's say there is some changes in June month monetary policy meet. So you have to take care about these particular changes as well, right? So today we are going to talk about monetary policy, and I'll try to make these particular thing very I'll try to explain in very simple language so you can easily get these particular thing, right? So whenever we talk about monetary policy, first thing you guys need to remember, so this is basically administered by the central bank, and in India it is managed by RBI. So monetary policy is basically function of RBI. So we have 2 policies. One is fiscal policy, another one is monetary policy. Fiscal policy that is administered by government of India, and monetary policy that is managed by RBI. So what is the meaning of monetary policy? So through monetary policy, RBI or the central bank that generally control liquidity. So liquidity means supply of money. Whenever we talk about liquidity, it means supply of money. So through this particular policy, RBI that generally manage liquidity in the market. Now what are the goal of this particular policy? So to create a win-win situation between growth and inflation, right? So growth and inflation, to create a balance between growth and inflation situation, right? So I hope you guys understand, if there is a excess liquidity in the market, so if there is a high liquidity in the market, so there is a problem of inflation, right? So if you'll have more money, you will spend more, so the prices will go up. So first thing, if there will be higher liquidity in the market, there will be a problem of inflation. If there is a less liquidity in the market, so if businessmen they'll not have money in their hand for new projects, so the overall productivity of economy will goes down. Okay, if you will not have money, so you'll make less demand. So there is a less demand, which means the overall productivity of that particular economy will goes down. So liquidity, we have to create liquidity at a certain level, and that things is generally done by RBI through monetary policy. So if you see the process, so monetary policy is the process through which RBI or the central bank that generally manage liquidity. Liquidity means supply of money, often targeting, we have targets like inflation, to maintain growth, or if there will be growth, there will be employment, right? So if you define monetary policy, now it become very simple. So monetary policy is the process through which RBI or the central bank that generally manage liquidity in the market, and they generally try to achieve that particular goal. They can manage the proper balance between growth and growth and inflation level, like so we need a inflation. I hope you guys remember our last video. So the suitable range of inflation as per RBI or as per the monetary policy committee is 2 to 6% or 4% plus to minus 2. Okay, so this level is generally managed by RBI through this particular one. And if growth is like the overall growth of economy, which is very necessary for like being a developing nations. We have to achieve so many targets. So we have some priorities. To achieve that one, we need money. So there is a balance between growth and inflation, and that is created by monetary policy. So if you define this particular one, now you get now you'll easily get this particular definition. So as with previous chart, we go through these particular concepts. So monetary policy is the process by which the monetary authority, which is RBI in India, control liquidity, often targeting inflation rate. The primary target is inflation, then growth, then employment. Why I am saying primary target is inflation? Because if you study fiscal policy, so if you see the target of fiscal policy, the major target is growth, because fiscal policy is generally run by Government of India, and we have election system. So politicians, they have to show some growth in 5 years, right? So they are always growth oriented. And first fiscal policy came, like we have budgetary system, so that generally published on 1st of February for next financial year. So first they came, they announced schemes, they announced the allocation of resources, the allocation of expenditure for the upcoming year. Then monetary policy with bi-monthly policy, they generally try to manage the inflation level in the economy as well. So hope this is clear to each and everyone. Now before coming to the monetary policy instrument, how RBI manage liquidity by using different tools. So there is a decision making committee which is generally known as MPC, Monetary Policy Committee. So previously means before this particular date, before 2016, this decision is generally made by, there is a board of RBI. So they generally come together, they generally do voting and all. So that process was quite big. So in 2016, we came up with a proper team of 6 members that is generally known as Monetary Policy Committee. So it is introduced under the Finance Act 2016, and the right are given under RBI Act 1934. So there are 6 members in Monetary Policy Committee. 3 members, they are generally represent to RBI, including governor, and 3 members are from Government of India. Okay. So 3 members from RBI, 3 members from Government of India, and this is generally headed by RBI governor. Okay, if examiner asks who lead this particular team, so your answer will be RBI governor. Or even like every 2 months we have this particular meeting. So if there is a case of tie vote, like in every 2 months these 6 members or this MPC meet. So they generally discuss the current situation of inflation, the current growth situation, or you can say they generally analyze the current liquidity status in the market. So if after their discussion, they generally do voting. So if in any case there is a tie vote, 3 people are saying there is a need of liquidity in the market, but 3 people are saying there is no need of further liquidity, we should maintain a status quo, right? So in that particular situation, RBI governor, they have a dual vote right? So if RBI governor is saying we need to increase liquidity, so that decision will go in the favor of RBI team. If they are saying we should decrease liquidity or we should maintain the same level, again the decision will go with RBI governor only, right? So this meet is generally handled bi-monthly nowadays. If you study from last 2-3 years, in every 2 months they generally conduct this particular meeting. But if you see the procedure, if you see the legals, so there should be like this meeting should be at least 4 times in a year. If examiner asks like how many times this meeting should be conducted by MPC team. So your answer will be at least for 4 times. It can be more than 4 times as well, right? Monetary scale. Now, what is monetary scale? Whenever you analyze the current monetary policy announcements, so whenever they made any changes, let's say they increase a repo rate. Let's say they increase repo rate from 6.25 percentage to 6.50%. Okay, so if you'll see the announcement, they'll say कि repo rate is increased by 25 basis points. So basis point is we generally use this basis point for the measurement. Like for the measurement of this marker, we'll use millimeter, centimeter, inches. We use kilograms and the other things. We have different measures. Similarly here as well. So 1% is equal to 100 basis point. So they increase repo rate by 25.25%. 6.25 to 6.50, which means they increase repo rate by 25 basis point. If let's say they increase repo rate by 0.50%, so you will see they'll say the repo rate is increased by 50 basis point. Okay, so this is just for your understanding. So monetary policy committee, which is basically decision making committee on monetary policy in India, right? So it came into existence from April 1st 2016. Usually they conduct meetings on bi-monthly basis. So hope this is clear to each and everyone. Still guys, if you face any problem with any point, please feel free to reach. Okay, now if you talk about the monetary policy, so we have two type of monetary policy. As these names state, one is quantitative in nature and another one is qualitative. So we have two type of monetary policy basically, or the entire working of monetary policy is divided into two parts. One is quantitative changes or quantitative methods, another one is qualitative. Now what is the difference between quantitative and qualitative? So whenever we talk about the quantitative, so it means we are talking about numbers. So there is a changes in certain numbers. Let's say they increase repo rate by 25 basis points. So what will be the impact of 25 basis point in on the liquidity? That is pre-decided. If they increase the CRR by 50 basis point, so what will be the impact of this 50 basis point on the liquidity? That is already defined. Okay, because that is something related to numbers. But qualitative is like when some other decision made by MPC during their meet. Okay, so they came with some like they changed the margin for loaning, they change something, they come with some new guidelines. So that is generally part of your qualitative, right? So we will start with quantitative tools first, then we'll come to qualitative tools as well, right? So guys, whenever we talk about the quantitative tool, as I already told you, so it is something related to numbers. Okay, for every tool you will have some number, some certain number. Like if RBI is changing CRR by this percentage, so this will be the effect on liquidity on the market. So this is the basic crux of your quantitative tools. Okay, so we have number of tools. These tools are further divided into two parts. One is direct, another one is indirect. Direct tools, we have CRR, cash reserve ratio, and SLR. Now what is difference between direct and indirect? So direct means they have a direct impact on the liquidity. Let's say RBI, when you will discuss this particular tool in detail, you'll easily get that particular one. Okay, so let's say the current CRR is 4.25%. Suppose that, so RBI increase it to 4.50%. Now this 25 basis point changes equal to, suppose that, 50,000 crore. Okay, so here the 50,000 crore from, like RBI will observe 50,000 crore rupees from the market. So there will be 50,000 crore less liquidity in the market. There is no other way, right? So that is a direct impact. But in case of indirect, let's say if you talk about repo rate, so let's say the repo rate is, previous one was 6.25%, and RBI, they generally change it to 6.50%, suppose that. Okay, so now repo rate is RBI to commercial bank. So that loan which commercial bank was earlier getting at the rate of 6.25, now they are getting at 6.50%. So if bank are getting loan from RBI at a higher rate, so they'll also offer loan to customer at a higher rate of interest. So definitely they are going to increase the lending rate or the loan rate for the customers. But in this case of indirect, it is a time taking process. Okay, as RBI increase, after some time bank will also start increasing their base rate. Okay, base rate is basically the rate below which bank do not lend to customers. Let's say a bank like SBI base rate was supposed at 8% for home loan. Now after this changes, they also increase base rate by 8.25%, which means SBI is not going to give loan to customers below 8.25%. So that is indirect, but this decision is generally made by bank itself. So this minimum that prime benchmark lending rate is generally decided by the bank itself. So they'll definitely going to increase their rate, but when they'll increase, that is totally decided by the bank itself. Okay, so hope you get these particular thing clearly. So with now next thing we are going to discuss, that is will talk about what is CRR, what is SLR, what is repo rate, what is TLTRO, targeted long-term repo operations, which is generally introduced by RBI during COVID situation. We have reverse repo rate, we have MSF, we have bank rate, we have term repo, we have standing deposit facility. This was introduced by RBI in 2022. Okay, this is a collateral free loan facility for the bank itself. So again, this is very important for your examination purpose. So now we will understand what is CRR, the theoretical portion. Then we'll come to how RBI used CRR to manage liquidity, right? So first tool, we have direct tool. First one is CRR, current cash reserve ratio, and another one is your statutory liquidity ratio. So CRR, the current CRR is 4.50%. And guys, one thing, like this rate is generally decided by MPC during their monetary policy meet. So it is variable. So as of January 2023, I'm recording this video in January 2023, it is 4.50. So after, like, the next meeting is scheduled for February 2023, maybe they change this particular one, maybe they increase or maybe they decrease or maybe they maintain the same level. That is totally depend on the liquidity status in Indian economy, right? So you have to update this particular one, or I would suggest whenever RBI come with their monetary policy meetings, so it is a must read for all of you, right? So you have to read these particular thing, and still, like, if you have, even I'll also come with some analysis of these monetary policy meet, but you should also read this particular one, so that will definitely going to help you. Okay, so what is CRR? CRR is cash reserve ratio. How you will understand, how you will remember this one? So I hope you understand this particular term, that is NDTL. So a portion of their NDTL that a bank must maintain with RBI in cash. So every bank, NDTL is net demand and time liabilities, which is, like, you can say, like whenever bank do credit creation in the market, so there is a certain amount that bank hold. Let's say a bank who have 100 crore rupees of NDTL. So there is a XYZ bank who have 100 crore rupees NDTL. So out of this 100 crore rupees, so which means they have 100 crore rupees in their hand for lending. Okay, so every bank, they have to maintain NDTL. So let's say the NDTL of any XYZ bank is 100 crore rupees. So out of this 100 crore rupees, they have to deposit a certain percentage of CRR, which is maintained in the form of cash, and that is maintained with RBI. So every bank, every commercial bank in India, whatever their NDTL is, they have to maintain a certain percentage. CRR means, like, current it is 4.5%. So out of this 100 crore rupees, they have to maintain 4.5 crore rupees with RBI. So they have to deposit this money with RBI in the form of cash. And RBI will not give any rate of interest on this particular lending. So suppose that SBI current NDTL is 100 crore rupees. So out of this 100 crore rupees, they have to deposit 4.5 crore rupees, or they have to maintain 4.5 crore rupees with RBI. They have to deposit this money with RBI in the form of cash, and RBI will not pay any rate of interest on this one. So RBI does not pay any interest on the CRR. So this is, you can just understand this thing as a rule one. How RBI use this particular one. I'll explain after the SLR. So just remember the tool. Okay? So suppose that there is a bank whose NDTL average. This is generally maintained on fortnight basis. Like bank, they have to report it on fortnight basis, which means every 14 days. So whatever their NDTL, they have to deposit some amount with RBI in the form of cash. Right? Now next one is SLR. Statutory liquidity ratio. So again, a portion of NDTL. So let's say same bank SBI, their NDTL is 100 crore rupees. So now they have to deposit a certain, they have to maintain. So here they have to maintain. In previous case, they have to deposit with RBI, but in the case of statutory liquidity ratio, they have to maintain with itself. Please do remember these particular point. Okay. So they have to maintain a certain percentage of NDTL. Certain percentage means whatever the current CRR, current SLR. So in case of CRR, they have to deposit in the form of cash, but here they have to maintain in the form of, they have alternatives, like they have cash, they have gold, they have government securities, right? So let's say our same example, the NDTL is 100 crore rupees. So out of this 100 crore rupees, they have to maintain 18 crore rupees with itself. They have to maintain this amount with itself in the form of gold, or they can maintain in the form of cash, they can maintain in the form of government securities. So this is like CRR with RBI and SLR with itself. Now if you see this particular calculation, okay, now what is basically what outcome of this particular one, I'll let you know. Okay, just I'll just erase this data. Okay, hope this is visible. I'll hide myself for a while. So guys, see, now you have two tool. First one is CRR, that is 4% that bank have to maintain, 4.5% that bank have to maintain with deposit with RBI. Another one is SLR, that which is 18%. So the bank have to maintain this one. So if you'll add, so it is 22.50%, right? Now from here you'll understand the basic working of banking. So bank, if you talk about the definition of bank, which is the meaning of bank is borrowing for the purpose of lending. So they generally borrow money from those who have excess money, and they lend that particular money to those who require that particular one, right? So the borrowing and lending is the primary function of bank. So the rule 1 or 2 says, if a bank borrow 100 rupees from the market, okay, let's say there is a bank who borrow 100 rupee in the form of Kasarapa, which is NDTL for this particular bank. So out of this they have to deposit, or they have to maintain 22.50% or rupees in the form of CRR and SLR. They cannot lend this particular money, right? So now the remaining one is like 77.50 rupees they can lend to the customers. So this is the current liquidity status in Indian market. So which means if a bank who borrow 100 rupees from the public, so out of this 100 rupees they have to maintain, or they have to deposit 4%, 4.5% they have to deposit with RBI. So 4.5 rupees they'll give to RBI in the form of cash, and 18% they'll maintain in the form of cash, gold and government securities. So 100 minus 22.50, so now they have 77.50 in their hand to lending. So they can give this particular money to customers in the form of loans, right? It can be car loan, it can be education loan, home loan, or any other one, right? So this is the current liquidity status in Indian economy. Hope we get this particular thing clearly. Still, if you have any doubt, please do mention in comment section, right? So now the exercise is, if you see this particular one, you will get more clarity. So quantitative tool is CRR, and current CRR is 4.50%, right? And current SLR is 18%. Now try to solve these particular one. So RBI action, if RBI will increase, I'll also add the liquidity column here. So liquidity. Please do understand this particular thing so you'll get more clarity. So if RBI increase CRR, if RBI increase CRR, the current CRR is 4.5%. Suppose that RBI increase it to 5%. So what will be, if RBI, now previously bank they have to deposit, I'll give you the clear case. So now suppose that after this increment it become 5%. So previously bank have to deposit only out of 100 rupees, they have to deposit 4.5 rupees with RBI. Now they have to deposit 5 rupees. So which means there is a less liquidity in the market. So now they have to deposit more money with RBI, right? Similarly, vice versa, if you come, if RBI decrease it to 4%, let's say RBI decrease it to 4%. So now they have to deposit only 4 rupees to RBI. Previously it was 4.50%, right? So there will be more liquidity in the hand of bank. So they'll have more money to lend customer. They have 50 paisa more to lend to the customers. So now hope this is clear. So if RBI increase, so there will be less liquidity. Now if there is a less liquidity in the market, so what will be the impact on inflation? Inflation will also goes down, right? So if there is a less liquidity in the market, so we'll have less demand. So if there is a less demand, the inflation will also goes down, and vice versa. If the RBI increase the liquidity, so now we'll have more money in the market, so the prices of goods and services will increase, which means there will be more inflation in the economy, right? Similarly for SLR, so the current SLR is 18%. Suppose that RBI increase it to 19%. So now they have to maintain more money. So there will be less liquidity, inflation will decrease, and if RBI decreases to 17%, so there is a more money in bank, so they have more money to lend, so the inflation will increase. So now what type of question you may face? RBI may, like examiner may ask simple question, what is CRR, what is current rate of CRR, or the other thing, or even like nowadays the most of time they generally ask question based on this table. So they'll give you one cases, if RBI increase, like in last bi-monthly policy RBI increased CRR by 25 basis point, so what will be the effect on liquidity, what will be the effect on inflation prices? So you have to remember this way, okay? So hope this is clear to each and everyone. Still guys, please feel free to ask. If you have any query, do mention in comment section. Now we'll move to the indirect instrument. What is indirect? I earlier told you. So we have a long list here, like we have repo rate, TLTRO, long-term repo operation, reverse repo rate, MSF, bank rate, MSS, open market operation, market stabilization scheme, and standard facility. Okay, so standard lending facility, we'll talk about this one. The first one we have repo rate. Repo rate, which is also known as repurchase rate. Okay, and the current repo rate is 6.25%. I'm talking as on January 2023, and you have to maintain this particular one. You have to update yourself, right? So now what is repo rate? I'll try to explain through a chart. So repo rate is rate at which RBI lend money to commercial bank. So this is a lending rate basically. The rate at which RBI lend money to commercial bank. So the cash flow is RBI to commercial bank. Please do remember cash flows, okay? So like I hope you guys read about RBI work as a bankers to the bank. How? So if examiner asks, or if interviewer asks how RBI work as a banker to the bank, so when bank required any assistance from RBI, so that is fulfilled by RBI. Let's say if any bank required fund for short-term duration, so they can borrow money through repo rate. So this is for short term. Short term means here 90 days. Okay, so this is up to 90 days. So the rate at which RBI lend money to commercial bank for short term, so that rate is known as repo rate. Let's say I'll give you an example. So let's say State Bank of India, SBI, who borrow 5 crore rupees from RBI for suppose that 45 days. Okay. So if SBI is borrowing money from RBI, so RBI, like being a lender, RBI will charge some rate of interest. Okay, so that rate of interest will be your 6.25%. So per annum, these are per annum. So that rate of interest is generally known as a repo rate. How it will impact the liquidity and inflation? That is same. How it is same? So let's say if RBI increase repo rate from 6.25% to 6.50%. Okay, so now this bank will get a loan at a higher rate of interest. If he is getting higher rate of interest loan from RBI, so he'll also charge high rate of interest from customers. So like if customers are getting loan at a higher rate of interest, they'll take less loan. So there will be less liquidity in the market. So the fundamental or the concept is same. Hope this is clear. Now this tool was introduced by RBI during COVID situation 2021. Okay. So TLTRO, which is stand for targeted long-term repo operation, and you can easily understand this one. How? First one is it is targeted. Okay, T means targeted. So targeted. So we are targeting COVID-19 situation there. So that time we was targeting about COVID-19. First one, long-term means here bank they generally can take loan from RBI for 1 to 3 years. Okay. So they can take loan from RBI 1 to 3 years at repo rate. Okay, so whatever the repo rate, so like at present repo rate is 6.25%. So if RBI open this particular window, so bank will get money for long term period for 1 to 3 years at the rate of 6.25%. I hope now you're getting this particular concept clearly. So what will happen if bank are getting money at a lower rate for a higher time duration? Okay, so they'll also give loan to customer at a lower rate of interest, right? So their base rate will goes down. So now you study this particular definition. The TLTRO or LTRO is a tool under which central bank provide 1 to 3 year money to bank at a prevailing repo rate, whatever the current repo rate. Okay, accepting government securities for the collateral purpose. Let's say State Bank of India borrow 5 crore rupees from RBI for 3 years. So they have to deposit some collateral like government securities and all. Government securities means securities issued by Government of India. It can be bond or any other tool. So as bank get long-term funds at a lower rate of cost, in return they'll reduce the rate of interest for borrowers. So LTRO help ensure that bank reduce their marginal cost of fund, that is base rate, lending rate, without reducing the policy rate. So this was the agenda of this particular tool. Hope this is clear to each and everyone. Next one, SDF. So this is newly added. This was introduced by RBI in 2020 only, and this is similar to, like, this was earlier your we can say this is similar to your reverse repo rate, but here with this particular in reverse repo rate, the current reverse repo rate is 3.50%. Here they are getting 6%. Okay, the standing deposit facility is a collateral free liquidity observation mechanism implemented by RBI. The intention of transferring liquidity out of the commercial bank into the RBI. Let's say any commercial bank who have excess money, who have surplus money. So previously we have reverse repo rate, but the reverse repo rate interest is very low. Okay, so now let's say State Bank of India who have 5 crore rupees excess money. So now they have two options. They can maintain that particular money with themselves itself. So they are not lending to, suppose that they are not getting any right customers. So if they are maintaining with themselves, so they have to, because this money belongs to public, so they have to pay some rate of interest to the public. Now another option is they can deposit this money to RBI and they'll get a rate of interest which is on an average or above average from from that particular bank borrow from the market. Let's say if you see the average of CASA and RAFA, that is around 4 to 5%. Now here bank is like they deposit money and they lended this one to RBI. So RBI will settle that particular money. RBI will use that particular money, and so this is overall liquidity management for the banking system as well. Next tool we have reverse repo rate. So this is just opposite of repo rate, and the current reverse repo rate is 3.35%. So the rate is like the rate at which RBI lend money to. Sorry, this reverse repo rate is the rate at which commercial bank lended their money. So the cash flow is commercial bank to RBI. So the rate at which commercial bank deposited their money with RBI or their excess money with RBI. So here let's say State Bank of India, as I gave you an example, 5 crore rupees, they have this excess money. Excess money is Like they don't find any customer to lend that particular one, or right customer. Okay, they have the surplus for 1 day, for 5 days, for 10 days, so they can deposit it to RBI. Okay, so RBI, so they'll charge some rate of interest, so RBI will give some rate of interest to the banks, and that rate of interest is your reverse repo rate. So now despite of this reverse repo rate, they generally go for SDF. So SDF basically promoting banks to deposit their surplus with RBI, so RBI can circulate that particular money in economy, and even they are getting high rate of interest as well. Now next one, we have marginal standing facility. So if you study the marginal standing facility, it is the rate at which RBI lend money to commercial bank. Please do remember the cash flows, that is very important. So the cash flow is RBI to commercial bank for overnight. So now this tool is very like you have to deep dive to understand this particular tool. I'll try to make your understanding. So RBI to commercial bank for overnight means 24 hours. So how it is possible RBI lended money to bank and they return that particular money in 24 hours? No, this is a cashless transaction. First thing is, this is a cashless transaction, and it is maintained through SLR securities. Okay, so now I hope you remember that point I earlier told you, CRR and SLR. So these are reserved. So every bank, they have to maintain these particular reserve on fortnight basis. In every 14 days they have to report RBI in every 14 days. So let's say there is a bank whose NDTL was 100 rupees and they landed, their maximum was they can lend 77.5, but they landed 78 rupees in the market. So first they borrow 100 rupees and they landed 78 rupees. Now the remaining 22, they have remaining 22. Out of this, they have to maintain 4.50 CRR, and SLR is 18%. So now they have a shortfall of 0.50%. They have a shortfall of 0.50%. So to maintain this 0.50 shortfall, because they have 100 rupees in their hand, they borrow 100 rupees, they landed 78 rupees. Now during fortnight meet, when they reporting RBI, so first they'll deposit cash 4%, 4.50% with RBI. Now their remaining amount is 17.50, but the current SLR is 18%. So they have a shortfall of 0.50%. So now to maintain that particular one, we assume, or RBI generally said, okay, for this 0.50%, I'll charge some rate of interest, which is your MSF rate, which is your current MSF rate. So first you have to maintain this one. But here the condition is, under this facility, eligible entities can avail overnight up to 3% of their respective SLR. Okay, so there is whatever their respective SLR, like if the bank NDTL is 500 crore, so their SLR will be different. If 5,000 crore, their SLR will be different, right? So hope you're getting this particular. So the maximum cap is they can avail up to 3% of the whatever their respective SLR portion. Okay, then let's say their SLR percentage is 500 crore. So out of 500 crore, they can use only 3% of that particular amount. Hope this is clear. Next one, bank rate. Bank rate and MSF rate are always same. So this is very simple tool. The rate at which RBI lend money to commercial bank, the cash flow is RBI to commercial bank for long term, or you can say for more than 90 days. Okay, so more than 90 days. Now the difference between repo rate and bank rate is, repo rate RBI to commercial bank for short term. If you talk about repo, so repo, it is RBI to commercial bank for short term or for 90 days, and bank is long term. Here in case of repo rate, they have to deposit collateral, but this is without collateral. Okay, so please do remember this one. Now next one, we have apart from these particular tool, we have one function that is called open market operation, which is performed by RBI, that is more closer to monetary policy. That's why I included this one. So whenever we study, RBI work as a bankers to the government of India. So how, if government of India needs some funds for short term as well as long term, so that is they ask for RBI. So RBI issues some government security on the behalf of government of India, like treasury bills. So let's say RBI issue some T-bills on behalf of Government of India, where we have a Government of India promised to pay this amount after this date. Okay, so RBI issue this particular one, and which means RBI sell. So after 91 days, RBI will buy this particular one, or similarly in case of bonds and all. So this buying and selling process of government securities is known as through RBI is known as your open market operation. So buying and selling of government securities through RBI is called open market operation. So here is the chart. So I hope you remember these particular one. Similarly, you can use this one for the remaining one as well. Like I'll give you an example. Let's say repo rate. So repo rate, if RBI increase repo rate, current repo rate is 6.50%. If RBI increase it to 7%, what will be happen? So there will be less liquidity in the market. So there will be less liquidity. If there is a less liquidity, so inflation rate will decrease. Correct? Then if RBI decrease it to 6%, so now bank will get loan from RBI at a lower rate of interest. So there will be more liquidity in the market. So if more liquidity, the prices will goes up, or because of high demand. Okay. So this way you can use this particular concept as well. So guys, these are basically quantitative tools. Now we'll talk about qualitative tools. Qualitative tools are kind of theoretical tools. So we have four major tools under qualitative measures. So qualitative as you know, in quantitative we have certain numbers. If there is a changes, so we know the impact. But in qualitative, we are generally trying to, like, these are the decision making of RBI other than quantitatives, which also impact the liquidity in the market. Okay, how? First we have credit rationing. Okay, so limit the loan and advances. Now RBI, let's say some banks, they are facing NPA in some specific category. So RBI come with some guidelines. You cannot lend beyond this particular limit. Okay, or even like we have PSL guidelines, priority sector lending norms. So if you are if you are operating any commercial bank in India, you have to lend 40% of your ANBC to the priority sector. So now there are some limitations, okay, which also impact the liquidity in the market. So time to time RBI increase or decrease these particular one. Concessional rate of interest, let's say RBI, Government of India, they supporting made in India concept, so for startups and all. So RBI said if you are lending in agriculture, so this is the rate of interest you will charge. Okay, so that kind of moral Susan, they can also come with some guidelines, do not cheat customers and all. They can set some policies. Changing margin requirement, let's say in case of margin, let's say for a home loan, if you are taking home loan, so you have let's say the margin is 20%. Let's say you buy a house of 1 crore rupees. So being a buyer, being a owner, you have to pay 20%. So now RBI capped this one to 25%, which means bank customers, they have to pay more money to this particular segment, or even RBI can reduce this one, so that margins for any financial product can also make an impact on the liquidity, right? Then we have some direct action like prompt corrective actions, which is PCA, prompt corrective actions or others. And then regulating consumer credits, the loan related guidelines and all. So there are so many different tools. Basically these qualitative measures are divided among four parts. One is credit control methods, lending related things, moral suasion, changing in margin requirements, and credit rationing. So these are the tools. They do have impact on liquidity, but they are time taking process, or even we cannot decide, or we cannot define the exact the numbers about these particular tools. Okay, so one request to all of you guys, please go for the current monetary policy updates. So in every year you will find at least 4 times this policy meet. But if you see 4-5 years, so they conduct this particular meeting in every 2 years, right? So the last bi-monthly meeting that was happened in December. Now next one will happen in February. Then first bi-monthly meeting for financial year 23-24 will happen in April. Then June, then August. So in every 2 months you'll MPC, they generally conduct this particular meeting, and even they update these particular one. As of now, these are the current one, but after some certain meetings, they may change these particular tools as per the economic requirement, or even apart from these particular instruments, they also made some announcement toward the margin requirements, toward the new product launch, or the other things as well. So you have to read that particular one very carefully, and that is the most important for your examination purpose as well. So hope guys you get these particular thing clearly. Still, I would say if you have any query related to any point regarding monetary policy, so do mention in comment section. I'll try to resolve your queries. And one thing, one request to all of you guys, please do make your notes, and if you like the video, please do share with your friends, and do subscribe my channel. Okay, very soon I'll come with MCQs as well, so question based on these particular topics, which is definitely going to help you for your upcoming examination. So hope you get this particular topic clearly. Still, any doubt, feel free to reach, feel free to ask. And if you have any financial topic or any economic topic which is bothering you, do mention in comment section. I'll definitely come with videos. Okay, so this is it from my side guys. Thank you for watching this video. Bye bye, take care all. Thank you.